AM Best is maintaining a stable outlook on the global reinsurance sector. The outlook is supported by several positive factors, starting with the fact that the industry remains strongly capitalized, as has been the case for a number of years. We also see continued positive pricing momentum in most business lines, driven by the need to keep pace with loss cost inflation, elevated catastrophe activity, and a challenging investment environment. All of these factors should keep companies focused on improving underwriting results in order to generate adequate returns on capital, which have proved elusive for many reinsurers. AM Best also expects demand for reinsurance capacity to grow, with primary companies seeking to reduce their own volatility as they continue to grapple with uncertainties related to issues like climate risk, social inflation, cyber exposure, and for the first time in a number of years, the possibility of global economic inflation due to accommodative monetary policies that have been in place for a sustained period. At the same time, reinsurers are contending with the less favorable implications of many of the same factors that are helping to drive the favorable pricing environment. Social inflation has driven loss cost trend in certain casualty lines for several years, with no apparent catalyst to curb its impact. And there are now indications that social inflation may be creeping into property coverages as well. Property underwriters had already been dealing with demand surge issues that may now be exacerbated by global labor and supply shortages post-COVID-19. Taken together, these and other issues appear likely to at least reduce the contribution of prior year favorable reserve development to reinsurers' results. AM Best expects that pricing will improve for most business lines at the upcoming January 1 renewals and continue into 2022, although rates will likely rise at a slower pace than what we've seen the past few years. One area where rate improvement could disappoint is in more remote layers of catastrophe lines, where the presence of alternative capital continues to mute pricing gains to a certain extent. The overall level of alternative capital, particularly in the cat bond market, has remained fairly resilient, despite these vehicles seeing significant losses and capital trapped for longer than anticipated due to the elevated catastrophe activity witnessed in recent years. Although some ILS investors may have grown wary of the insurance space, AM Best does not expect third-party investors to pull back broadly from the catastrophe reinsurance market unless better investment options emerge. In casualty and specialty lines, robust pricing gains have attracted the attention of both startups and more established players looking to diversify away from property cat exposure. However, AM Best does not expect new market entrants to meaningfully impact pricing or terms and conditions. For the most part, new entrants in the market have been niche players filling in gaps rather than driving pricing or setting terms. In a lot of ways, the challenges faced by reinsurers are also driving the opportunities as they manage their way through an uncertain world. The next few years will be important for the reinsurance industry. Results will be pressured by factors including social inflation, property loss cost inflation, low investment yields, climate risk, and a fragile global economy that is still recovering from a global shutdown. It will be critical that the industry practices careful risk selection, including taking more rate and tightening terms and conditions where needed, as well as allocating capital as efficiently as possible.